Hey, yo, everybody. Welcome. We're going to start in 20 minutes here with Nic Chahine. You guys already know him from the newsletters and the options chat room, all that stuff. We're going to start in 20 minutes. We have a great session planned for you today, guys. So just stick around or, go get a drink, get a beer or something, food, whatever. We'll be back in 20 minutes to start. We'll be around 1-2 hours or so, but make sure to participate. We're going to have a great session planned for you guys. So we'll see you here in 20. All right. All right, welcome everybody. We have a great session planned for you today here with Nic Chahine. Go ahead in the chat. I'm going to pull this up. Let me know, guys, when you are ready to start. I'm going to go ahead and close this timer. I don't know what was happening with my mic there, but all right, it seems like we're good now. So without further ado here, let me go ahead and introduce here Mr. Nic Chahine. How are you doing, sir?
I'm doing good. Made a mistake today. I'll teach people how to not make the same mistake.
Yeah, and before we do get into all of that, 20 years in the game, Nic, I know that a lot of people know you here from the newsletters and of course the chat room, right? So for those that are not familiar though with you, if you would like to give, just a quick brief introduction
Sure.
before we do get into the lesson. All right.
Sure.
Thanks, Nic.
So I started out as an engineer, electrical engineering, and then I got into finance and business, and then left the corporate world, I think in 2000, I can't remember exactly, and never looked back. But throughout the whole time I was trading different. So I morphed my trading into what I'm doing now, which is full time, and helping people, get the drop on Wall Street, so to speak. They try to snow us with fancy terms and look here and look there, sleight of hands. But we got their number. We know how to break it down to plain, simple English and see how we can trade it, us non-Wall Streeters, and be more successful than we would have alone. So yeah, you can try to do it alone, but if you can leverage the information that somebody else has done and be in a room with 200, 300 other people, that's the best way to go. So that's what we do. We get together all day, every day. I do research. I do a lot of chart work for you. I share trade setups with you with full-blown videos. So that's how I spend my days. I have like 0 minutes to my own right now. I go on a lot of caffeine, and it's a pleasure because the group we have is insane. And people like Rodrigo and the Benzinga team behind us is just awesome. So that's what I do. That's how I spend my days, trying to will stocks up when they don't want to go up. So I'm sharing my screen. This is what I share all day, every day, with everybody that wants to be in the chat room with me. And today I was like, oh, come on, do this, do that. And it was like calling a video game or something. Sadly, I knew they were going to puke it all out right from here, right in the beginning of the day, and then here again. And I said I should short the market right now, but then I went on the Benzinga show and I did not short the market, and look what happened. So luckily, Apple is a green thing after hours. That's awesome. Finally, somebody that's reacting well. $167 after hours. Hopefully it holds its greens tomorrow so it can provide some leadership for the market. So that is the big picture as to what I do. And as to what we're doing here today, I believe we're here to discuss options and see how we can put them to use during this crisis. I'm going to call it a crisis of sentiment. There's no crisis. In fact, there's the opposite of crisis. Why is the Fed pulling the plug on the QE?
Because the economy is better now.
Because the economy is too good.
Right.
It's too hot. So the GDP today came out 8%. It's like 2 points above what they expected. That is a very hot economy. So how is that bad news? For example, Apple just delivered its report. I'm pretty sure it's a record report. Intel just delivered a report. I'm pretty sure it was a record report. Tesla crushed it. They grew 65%. They grew sales 65%. Who gives a rat's, what, if they missed somebody's estimate? They actually grew the sales 65% to last year. And earnings, which is basically the bottom line, 200 and something percent, 280, 220, I can't remember the number. So any which way you slice it, the results are strong, too strong. That's why the Fed's saying, you know what, in March, we're going to raise rates. That is not a bad thing. This is where good news should be good news. Usually they say good news, bad news. because good news in the economy is bad news, because that means the Fed's going to raise rates. Well, now we know they're going to raise rates in 2 months. There's a rate hike coming in March. He unofficially announced it yesterday. So now we know that the Fed's not our friend anymore. But that's okay. We're winning the game. That's the point. So give Wall Street time to get used to this new behavior. You know how a kid, if you've ever had kids before, you give them a binky, you know, something to stop them from crying. And then at a certain age, it looks weird when they're still sucking on that little binky, and then you want to take it away and they start crying for no reason. We're at that stage. The Fed has just pulled the binky out and everybody's crying. Hopefully they don't put it back in. In 2018, they did the same thing and the markets crashed in 2018 into Christmas. What did he do? He put the binky back in. He said, okay, the same guy, Powell, I'll restart the QE. And he did. So hopefully this is not Wall Street trying to get him to bring the binky back in, because we don't need it. Let's just get the Fed out of the way and let's just trade actual fundamentals. So that's what we are going to use options in order to allow it. So I just started saying I made a mistake today. So I'm long hood stocks. Okay. Going into the earnings, I knew they were going to sell it down because it has no good news. It's terrible. So I went and bought puts to protect myself. And they were bulletproof. I put in the order to buy the puts. And I looked away, I got busy in here, and I never checked if it filled. It missed by a penny. I did not get my puts. So tomorrow I'm going to take a bath on my shares because I failed to verify that indeed they filled. So where's the stock? Down 10%. Awesome. Sweet. Good job, Nick. So here's an operational mistake on my behalf. But my point is, I could have totally protected myself by spending, I think they were like $1 or 70 cents. So if I just bought one, I would have spent $100 to just protect myself for the next couple of weeks, 2-3 weeks. Instead, I'm going to take a bath tomorrow. So we can use options to protect ourselves, to catch falling knives that are worthy of catching. For example, Intel today, down 6% on a record quarter. Does that sound like intuitive to you? It doesn't. So we cannot rely on these people to do the right things. Therefore, we can use options to do the right thing and leave room for error. And we can discuss that a little bit later. So that's hopefully what we can do today. So before we get into all of that, how about you give me a number one in the chat room to tell me in the chat to tell me if you've never done options before and you want, like, what is a call, what is a put type of a conversation first. Just the one. All right. Only 2 people? 4. Wow, we have pretty educated bunch of group of people here. Okay. 5. Wow, this is a nice collection of people then. We don't have a lot of ones. That's pretty crazy. Okay, so we will just delve into, we'll just jump into how to use them. Perfect. So, okay, so for those who don't know what options are, 2, okay, Rob, thanks. Basically, they are contracts. They allow us to bet on the price action of a stock. For example, I mentioned Hood, not the best example, but February. So they are contracts. So basically they have terms, just like any contract, they do have terms. In this case, I chose February. It has 22 days. That's a term. How long is it, the duration of that contract? And then price, I wanted to buy the $10 puts and they would have cost me $100. So if I had 100 shares, I buy one put, and that would have protected me by giving me the right to sell my shares at $10 for the next 22 days at any point in time. All I have to do is call my broker and say, hey, I own this put. Can you please sell my shares at 10. So if we wake up tomorrow and the shares are at 8, I'm guaranteed a sale at 10. And if shares are at 9.50, I can sell them at 10. If the shares are 10.50, I can still do it, but I'd be an idiot. But I do have the right to do that. So that's a contract. There's a buyer, me, I wanted insurance. And then there's a seller, somebody out there that said, hey, you know what? I would love to have your shares at 10. So therein lies the deal. The seller and the buyer. I'm the buyer. I want insurance. The seller wants the shares that they sell insurance. The transaction cost $100 for me. I go to sleep knowing that, okay, if the earnings reaction tomorrow is going to be hideous, I'm covered. I put in the order, it didn't fill. So now I'm long the shares down 10%. Okay. That is a quick way of defining what a put is. So let me tell you how I would use it differently. I said I needed reason. My take is that I'm optimistic the economy. Clearly, the stats support it. The GDP 8%. Companies are delivering record profits. So the economy is humming. We do have inflation, and we do have inflation. But hey, so what? They caused it on purpose. They told us they're going to create inflation in order to create jobs. And they said, we can't measure it. The CPI is too low. The CPI is too low. I was like, the CPI is broken. I know I'm paying 40% more for milk than I used to about a year and a half ago. So you can tell me the CPI doesn't show inflation. I know everything I buy has never been more expensive for a fact. And I'm okay with it because I know you did it on purpose. You flooded the country with money. That's the byproduct. You spend trillions. Trillions is a lot of money. Therefore, it's going to make money worth less. That's the definition of inflation. Money is worth less. Worth less. That's all there is to it. And that's normal. We have record spending. So inflation is not a problem. Inflation becomes a problem when it crimps spending. So they're trying to protect the patient from a disease that is not lethal to them right now. So anyway, that's my take on it. So how can I use options in order to catch worthy falling knives? First of all, a falling knife is a good stock or is a stock that's falling out of control. In this case, I want to fish for good stocks falling out of control. What does that mean? Good stocks. Lucid is not a good stock, not because the company is not good, the car is not good or anything. No, because currently the fundamentals on a piece of paper are not there. So the goodness of it is in my perception, not in hard. Like Apple is a good stock. I can calculate, okay, sales are this, net bottom line is that. So I know that this is a mathematical thing. With Lucid, I'm not picking on it, but that was the first example that popped in my head. I have to actually make a determination in the future. Maybe they're going to sell this many cars. Maybe they're going to make this much. Maybe there's nothing now. So I would be guessing. I don't want any guessing. I want good stocks like Intel. I know for a fact that the PE is almost single digit. I know I'm not making a mistake buying the stock now. I know that for a fact. Even though it's not a perfect bottom, maybe, it is not a mistake. So if the stock market crashes, I know Intel does not have a lot to fall. Okay, so we can discuss that in a little bit. So that's the kind of stock I want to catch and leave room for error. So somebody's asking what period of time I have to call my broker. This is 22-day contract. So for the next 22 days, at any point in time, I can exercise my right to sell my shares. Had I put the stupid order, I would have called my broker tomorrow if it opened at 8 and say, you know what, get me out of the stupid stock at 10. Thank you very much. Right. So I could have done that for the next 22 days. That's the contract I have. I'm not obligated to do that. I can do that on my terms. If the stock falls to 9 or 8, and I decide, you know what, I read the report, I know they reacted badly to it, I still like the stock. Thank God I bought the put. The put is now worth $2. I'm making up that number. Probably it will be worth $2 tomorrow or $1.50. I want to sell the put. So if I did one, I would have made $100 out of thin air. If I bought two, I would have made $200 out of thin air. I would have said, you know what, let's just sell those, pocket the money, and forget the insurance. I don't want the insurance. And then I keep my shares. I get rid of the insurance. I get rid of the put. If I bought it to open, I can sell it to close. If I sell it for $2, I made $1. So $100 per contract. But I do own the right in this example for 22 days. Somebody may have done this and they would have made a mistake, because these things today are 3 times more expensive than they should be. Tomorrow at the open, this number right here, not 3 times, twice. This number right here is going to implode. It's going to get cut in half at least. So everything I paid for in here, everything, puts, calls, are going to lose pretty much half their value just at the open, regardless of how price moves, because of the implied volatility. This number, implied volatility, is right here, is going to implode. It's just going to go. I'll show you how different that is. This is the implied volatility for tomorrow's contract. Earlier, I showed you February. It's 157. That's still super high, but it's, 1/3 less high than this one, 1/3 of that one. So this is outrageously high. So that's why it makes sense for me to buy it here than to buy protection here. Like, why didn't you buy protection here? Because it's 3 times as expensive as it should be. In fact, here's the visual of it. Look at the difference. That's normal price. That's current price. Tomorrow, this will go to here. And then at the end of the day, it will go to here. And look, the difference shrinks with time. I don't know what this is. This is an anomaly. Okay. With so much volatility this week. Okay, so I am looking at a certain delta. So we clearly have good educated people in here. I'm glad. This is a change of pace for me. Every time we get into these, we have a lot of newbies, which is fine. I enjoy teaching newbies. It's not an insult. We've all were newbies at some point. So let's talk a little bit of what I like to do. So I'm going to switch off of hood because that's not a proper, let me see, does Intel have it? Tesla would be a good example. Let's go to Tesla. I'll give you an example that I discussed today with somebody at Tesla. I mean, somebody that did something with Tesla. So here's Tesla, which absolutely killed it on the earnings. The actual numbers versus last year, they were an incredible crush. In fact, I think they also beat the expectations, right? So I'm not sure what that's all about. Regardless of what it's about, if, let's say, I was looking to buy Tesla shares and now they're falling out of control. Let's go to Tesla. This is a weekly chart. So I use this high time frame, 1 week. Every candle is 1 week. Declutter. So you remember this rally? This made no sense. Whatever happened here, was that the split? Was that when they split? I can't remember what that was all about. Well, no, there's no split here. Okay, they reported, and then what was that all about? Whatever. So let's, I don't know what it was about. All I know is it wasn't proper. That's not right. But look, it's happened before. And what happened before? They gave it back. Why? They need to establish footing. And same here. They broke out. They're coming back to test the neckline from which they broke out. So technically, they should find buyers lurking through 750. Now, I brought the fact that if Tesla loses, I brought it up in our discussions all day yesterday as well. If we lose this guy, which is a pretty pivotal zone, we are likely to see 700s in Tesla, just from a price action perspective. It's not necessary, but technically it is doable. But guess what? Tesla is rarely a stock I shy away from catching on bad jags. And this is a bad jag, right? So you think about it as like, oh my God, this stock just collapsed 30%. But it does that often. That's Tesla, 40%. So see my alert? That's for me to start nibbling. But I could have done it today. However, I had bad luck, so I didn't do it. Here's what somebody did today. Somebody said, hey, did I make a mistake selling a $500 put in Tesla? I was like, no. Well, only answer me this. Are you willing to own Tesla at 500? They said, hell yeah. I said, okay, then no, you did not make a mistake. How could that be a mistake? So what did they do? They caught the falling knife of Tesla. They wanted to buy shares. They wanted to leave the idiots who are selling it now room to be more idiots. So they gave them another 39 to 40%. In fact, they gave them more. So supply chain issues, Terry, they've had supply chains issues for a year, correct? And they still crushed it. They sell out of every car they make. They don't have a sales problem. They are more profitable than GM and Ford on a per unit basis. So it is impossible for it to be sold on fundamentals. I don't care what the hell problem they have. Their problem is they cannot make enough cars fast enough to sell out of fast enough, and they're crushing it. They sold 1 million cars last year, 1 million EVs. So that's pretty, and I'm not a Tesla fan, trust me. And that's pretty freaking incredible. I'll show you a statistic later on fundamentals. If you're talking about fundamentals, I'll show you a statistic that is mind-boggling that nobody addresses. It's absolutely mind-boggling. Nobody addresses it. Let's finish the trade. Okay, so this person sold a $500 put. I'm going to guess and say they did April, maybe March. So they got paid, if they did April, they got paid $1,500 today, actually $1,000 today. That's what they collected $10. So they must have done April. At the lows today, they collected $1,000 today to promise that they will buy Tesla shares at 500 in the next, between now and the middle of April. So in the next 77 days, they sold insurance to somebody right here. They said, hey, you have Tesla shares, you're worried about it, you want to be out at 500. That person, the buyer of that put, must have entered Tesla much lower, and they're just buying insurance for whatever reason at 500. So they have the confirmation that if Tesla falls below 500, this person might stick me with the shares. So the idea is that I'm selling somebody insurance. I'm taking over the risk from them at 500. For that risk, they're paying me $1,000 today. So this trade is bullish. I'm spending no money for it. I'm collecting $1,000. I have to be able to buy shares. So the broker needs to see some cash in my account that tells them that this person may have enough cash to now or bring in some cash later based on their credit report that they ran before they opened the account. So they have to trust me that I have enough money to cover the purchase. And I'm on the hook for as long as that trade is open. I can buy it back at any point in time to close my risk. But that is a bullish trade that person did. And I would have done the same trade if it was me catching the falling knife. Now you're saying, you know what? I don't want to tie up that much cash. Well, first of all, it's less cash than you need to actually buy the shares. So it is pretty kick-ass way of getting long a stock, collecting $1,000, and not needing a rally to win. In fact, the stock can collapse another 40% before I would lose money. So the worst case scenario is Tesla continues to fall. Let's say it falls to 490. And one day I wake up, and this one would show me a lot of losses. The actual put position that I sold would show tremendous losses. It would be gargantuan, but I don't care, because as soon as I get assigned shares, that's when I wake up, the put position disappears, and instead will show up shares, because that's what I said. I said, I'll buy your shares. And if they stick me with their shares, the put position with all of its losses on paper will disappear, comes out of my account, gone. I keep the $10, I keep the $1,000 that I collected. So now my break-even point is 490. So my worst case scenario, if I wake up owning shares on Monday, I would just simply sell the shares and break even at 490, or decide to keep the shares and sell covered calls against them all day. You can ask Jason Raznick. He did that. He created, I think the last one he did, maybe it was his first, I'm not sure. We discussed it one day and I said, I would sell covered calls, and he created $2,800 from one trade. You know, he has the asset. Why not put it to use? So if it was 100 shares, he must have collected $28 per contract. That's $2,800. went into his account against his shares. So if I own shares, I can sell covered calls and create tremendous amount of money. I can do it week after week if I'm active. I can do it once a month, once a 6 months, once a year. I'll give you an example for once a year in a second to give you a visual as to how you can put your assets to work. So this is one way to withstand a downturn in the economy. So the idea here today is to, how can I use options to trade a bear market and still be bullish, not have to short the market? Well, you do stuff like that. A drop of 11% in Tesla is unusual. Guaranteed tomorrow it'll pop a little bit or ease up a little bit. Today the VIX closed red. That's also unusual. So what if tomorrow the VIX collapses more? If it does, then this put all by itself will be lower without Tesla rallying. Because the VIX collapses, that means all the options prices collapse. The VIX is priced off the options. So the shrinkage in the premiums means that this $1,000 may be 700 tomorrow. And if I sold it today and collected 1,000 and tomorrow it's 700, I'll buy it back. So that means I booked 300 out of thin air. I didn't even spend a penny. I collected 1,000 and now I paid only 700 back to close my risk. I can do that. So that's one way of doing it. Let's say I have a smaller account and there's no way for me to be able to sell a naked put. So I would do a credit put spread. Similar scenario, instead of collecting 1,000, I'll collect 100. But then I have the same odds of success. I need Tesla to be above this risk in the next 77 days to win. And that will give me about an 11% yield, 10 to 11% yield on my risk. Again, I need no rally. It can still fall 40% and I can still make my money. And this allows me to not lock up a lot of money. So in this case, I'm locking up $900, less than $900. So if I have an account with 6 grand, 5 grand, 10 grand, this is a totally doable trade. But as long as I'm choosing my entry points carefully. Now, if I do this in Upstart at 280 or 3 or 400, whatever it was, I'm making a mistake. I don't care how good I was in setting it up initially. I chose the wrong time. And let me show you the difference. Okay, so Tesla now, it just lost 20 whatever percent, 30%. Trying to sell a put spread now properly is good. Now, if I had done it, oh, sorry about that. If I had done it up here or up here or up here, I'm not doing it right. That's not enough. It's too high. I'm chasing too high. Upstart. I have somebody in my group. We went long here and we went long the day before it popped 17%. We're over here, I think. Yeah. But somewhere here, one person I spoke to sold a put spread. She structured it right. She chose the right number delta. Somebody just mentioned that. I'll explain to you what that means. So she did the right parameters. She didn't make a mistake in the parameters. She made the mistake with the timing. Up here, that is way too high. Look at that rally. There's no way on earth I would sell a put spread up here. I don't care if it dropped 20%, 30% or whatever. It's way too high. I mean, that's a whatever 180% rally, way too high. So that was an ill-advised move in hindsight for her. So choosing when to do it, like now, okay. If she went out and sold that same spread based on the same parameters anywhere in here, I'm with you. I'm okay with that. Okay. So it's called a credit put spread, bull put spread, and I'll show you the visual of it. It's a bullish trade that does not need a rally to win if you do it the way I do it. And I'll tell you what the parameters I'm looking for are and how it can be used in conjunction of other things. But let's go in it. All right, so in this case, this is a credit put spread. Gives room for Tesla to fall to 500. And by the way, none of these are actual trade alerts right now. So I don't want to see you go out there tomorrow and sell this one, because you need to know what you're doing, blah, 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 blah. Okay, there's a lot of other things going on. So what are the parameters I look for? I want odds in my favor. So the odds maker of the platform, this is an options chain. You have puts on this side, calls on this side. They have odds of success, theoretical odds of success. So it's a gauge that allows me to kind of tell if if I have a leg up, if I have an advantage, if I have an edge against my competition. So which one is that? The column is called delta. So the delta, the lower it is, you see that almost zero, the lower it is, the less likely that price is going to be here. In other words, let me put it in plain simple English. This says there's almost no chance, this is what the plain simple English, there's almost no chance that Tesla is going to be, Tesla is going to be 480 in 77 days. Let me rephrase it. This says there's almost no chance Tesla is going to be at 480 in 77 days. This is what literally that means, okay? So if there's no chance that Tesla is going to be, almost no chance, Tesla is going to not be at 480 in 77 days, I'm willing to take a risk there, right? So instead of me guessing where Tesla is going to go, how about where it's not going to go? That's what that tells me, and sell risk there. So for me, the sweet spot is anything close to 0.1. So the fact that this pays $1 is a gimme. It's pretty crazy. That's pretty high. It probably won't fill, but I'm okay selling from here on down statistically. So I'm okay taking a delta 15 or lower, 0.15. This gives me an 85% chance on paper or better of winning. Why? Because this says there's only about a 15% chance Tesla will be 600 in 77 days. So anywhere below this, the lower the safer. So if I'm selling risk, that's my risk. If I'm selling risk, I'm opening risk. I want to know that there's almost no chance I'm going to lose. That's literally what that means. So the only way I get there is if I get hurt by a surprise. So if Tesla shares are assigned in case of selling a put, how much amount I need to have in my margin account? Well, you need to have enough to buy the shares. That's as simple as that. You said you're going to buy the shares. They're going to take money to buy the shares. Okay. So,
hey, Nick, really quick here. A couple of folks are asking about the trade ideas, the newsletters that you have. So I'm just going to get over this.
I was going to jump into that. So today I shared a thought about Amazon, for example. So the trade ideas come from the research we do, and then once a day, depends on what group. What are we offering here today, Rodrigo?
So this is what we're doing, Nick. So the news. Let me tell you how it works, guys. The starter. All right, these are all monthly. So the option starter is one trade idea every 2 weeks. Okay, and that's going to be sent to you by email. You can get it on SMS text alert as well. $7 a month for that one. Once you complete that one, after it'll auto refresh and it'll take you to the next tier. That's the enhanced. That's 14 a month, and that's one trade idea every week. And then same process. Once you complete that, it'll take you to the tier 3. In that tier 3, that's where you get 3 to 5 trade ideas plus a lot of bonus content from Nick. And if anybody has questions on the chat room where Nick can explain a little bit more what he does, I'll drop my email for that specifically. But do you want to add anything there, Nick?
Yeah. Thanks for that, Rodrigo. So I'm begging you that if you join the starter program, to get hungry to move up right away, because it's only, if you jump into the chat room, and trust me, today we crashed a couple of times because we had too many people. But anyway, so what happens is there's an open dialogue all day between you and me and 260 people, and not one jerk in there. But what happens is I have these windows open all day. You don't need to be in there all day. But let's say you have a question and you just want to get a quick answer for it. You just pop in and say, hey, Nick, I was thinking about this. What do you think? You can direct message me in here or in the official Benzinga chat room. So just get your butts in the chat room. I know you can't get in there unless you're a Benzinga member. That's why we have that little step. And luckily, it's a tiny little fraction entry cost. But then get hooked up with the chat room, because then you and I can talk all day, every day. And I promise you, I don't ignore questions, not on purpose. Sometimes I miss them. They scroll off the screen, but you can direct message me. So if you want a dialogue to learn, like this one right now, Hassan had a question for me, right? So Hassan asked about how much money do I need? That conversation goes on all day. I wish I left the conversation open. I closed it. So I had those questions all day. Like somebody literally said, hey, did I make a mistake selling a put and buying a call? In fact, when they sold a put in Tesla, they also bought a call with the money. So they collected 1,000 and they spent the 1,000 right away to buy a call. So if Tesla rallies tomorrow, they're going to make a, can we cuss? No, crap ton of money, because they sold a put and bought a call. That's pretty aggressive. I don't have that kind of conviction right now. I would have sold a put, no problem. Maybe bought a call spread, not a call. And I'll explain the difference in a second. So yeah, doing a credit put spread for you, Hassan, means that you do not need to have gobs of money to trade Tesla. You can do the same trade with a tiny account and have a pretty good record. So these credit put spreads, when you design them to be like boring, like I just did, this was a boring trade. There's nothing sexy about it. They yield that kind of win rate, 90%-ish, 88 to 92, 94. Sometimes you go a long time without having a loss. And if you manage your risks properly, you rarely have a blowout, except for like if you shorted a company and then Affirm. Who said Affirm has a headline, or somebody bothered to actually pop in? Okay, Affirm is up 5.
So they Affirm, well, we've been talking about it for a bit, but apparently the breaking news is that they partnered with Visa to for their debit cards a couple of minutes ago.
Affirm is a bargain. I am long. I would be long. I would sell puts. I would buy long dated calls, buy shares, whatever. However you get long, the company is solid footing. Great concept. I love the way they touch the consumer from a like, hey, we're your friends. We empower you to do whatever. You need to replace your refrigerator. We can break it up for you. So it's an awesome concept. What is a credit put spread? Small account. No. So Patricia has a valid question, and let me see if I can use a different company. Okay, we'll use Affirm. Let's use Affirm since we're talking Affirm. All right. So I'll go to March. Okay. So this is, again, options table. Now we change the company to being Affirm. All these are contracts. I have some that expire tomorrow, some that expire next year, some that expires in 2024. I'm choosing March. 50 days. So everything here is 50 days. Okay. Whatever bet I make is for 50 days. And when I say bet, I don't mean casino. Okay. It's all odds. When you buy a stock, what are your odds? Awkward silence. Are we on a delay? Okay, I'll answer. I'm glad you said that. When I buy stocks, my odds are, thank you, Sayed. Said. So 50-50. Right? The stock can go up, the stock can go down. So I'm backing into what I usually open with. Okay, so why is that important? If I buy stock, I have 50-50 shot, right? So all my money is at risk right here, right now. If I pay whatever Affirm, if I buy 100 shares of Affirm, $5,100 on the line right here, right now. So there's no buffer. The stock falls, I'm starting to lose. The stock rallies, I'm starting to make money. I don't have an edge. Maybe I did homework. Maybe I knew. Maybe I had a feeling Visa was going to do this. Maybe I had a feeling that Affirm has hit a bottom. So I give myself better odds than my competition because I did homework, and I think that. So you give yourself maybe a little better than 50-50 percentage, but it's subjective. You give yourself that. You can't get a tangible number. Well, guess what? Here, I'm risking whatever I end up risking using options, and we'll discuss that in a bit. So that's the first part. How much money can I lose? Okay. And then the second part, the percent. What are my odds of winning or losing? That one is a gift It's right here. This one tells me what are my odds. So check it out. 51. So the odds are here somewhere. This is weird. These numbers are a little weird. So anything around current price, oh, that's because the price is jumping after hours. So right now, price after hours is 55. So this is where price is right now. Anything around current price is 50.5. See that? So this is your 50-50 shot. The lower I go, the less likely it's going to be. So again, what this is it says there is almost no chance that this company, a firm, will be $25 per share in 50 days. Again, I'll say it. There's almost no chance a firm will be $25 in 50 days. If you say it to yourself that way, that means is if I buy this thing, I'm literally have no chance of winning. If I want price to go here, I have no chance of winning, right? So here I have better chance, but it's still pretty freaking low, like whatever, 12% or 13%, 14%, 11%, something like that. That's still a low odds occurrence. So that's what I would be selling. So if I wanted to take a risk and sell somebody some insurance that is not likely to crash their car. So I'm looking to sell somebody insurance down here by selling the put, and likely that they're not going to crash their car. So I can either sell it to a teenager who drinks before he drives, or sell it to a responsible older person who lives in the desert and does not have any neighbors. Therefore, they're not likely to crash their car, right? So this is what I would want to do. I'd want to sell insurance down here. So what does that mean? If I sell that put, I collect $250, and all I have to do to earn that in 50 days is promise I would buy their shares at $35 in 50 days. They'll pay me $250 for it today, okay? So that is me selling a naked put. What is a naked put? Just selling a put. Okay, so if I wanted to buy the shares at 35, that's a big if. If and only if I am able and willing to buy the shares at 35, I would sell this put. If I wanted to do it at 30, I would sell this put. They both have pretty good chance they were going to work out my way, because price, according to the delta, is not likely to be there in the next 50 days. So if I sell this one, I collect $250. If I sell that one, I collect $150. What's the difference? Nothing. My entry price. I may wake up one day owning shares at 35 or at 30. If I did this one, where's my break-even point? Where do I break even after getting assigned shares? Let's see if you guys are following. I'll give you a second while I cough my life away here. Awkward silence. The teacher is looking at you. Okay, I'm going to answer. The break-even point is whatever assignment minus the cost. Yes, $32.50. Thank you, Alex. Parina. Thank you. Yes, minus the cost. So if I get assigned at 35, so if I wake up one day, because I said I would own the shares at 35, they assigned me the shares at 35, I collected $2.50 for them. So I would not start losing money after getting assigned until $2.50 below that. So that's the buffer. Here, I would break even at $38.50. I'm rounding, $38.50. So $28.50, I'm sorry. So not a bad deal to take a risk. Catching a falling knife. This is clearly a falling knife. Look at that stupid chart. That's Upstart. Let's go to Affirm. Not much difference. So this death, like who wants to bet on this stock? Every pop is getting sold. Every pop is getting sold. Do I have any lines? I must. Boom. Yeah. See, I put a representation. I said, look, who's in charge? The bears. Every pop is getting sold. So this is called optics mode for me. You cannot trust pops. They're smacking it down. So tomorrow, when it pops to here, I'm going to say, if you're not long, this is not the time to add longs, because what has happened for months, boom, right? Even though I like the stock, you cannot assume it's not going to be sold, okay? That's why you leave room for error. So I'm saying, okay, I'll buy it here or here, leaving room for it to fall more. Okay, that would be an all-time low. Yes, all-time low. Not too bad. Okay, so that is why I would do this. So now in comes the credit put spread version. Okay, and let me walk you through that logic. So like I said, I don't mind selling this one. But let me say I'm nervous about the next 2 weeks. You know what? I'm going to limit my maximum loss. I'm on the hook. When I sell a put, I am on the hook. I'm under control of somebody else's will. So I promised this person I would buy their share at 35. I do not have the option to refuse. I wake up owning shares. Okay, so I'm nervous about the next 2 weeks and the market and blah, 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 blah. Guess what? I'm going to buy protection below. So I collect 250, I give back 150 so I can sleep easily. I can change my mind a couple of days later and sell this back out. But for now, I want to be off the hook. I'm on the hook, I'm off the hook, on the hook, off the hook. So the net effect of this is me collecting $100, not $250. So if the worst case scenario comes out and the stock is collapsed to 25, I can only lose $5 per contract, 5. But not really, because I collected 1. So my maximum loss net is 4. This way it can go to 0. I'm only going to lose $400. That's it. So if it doesn't go there, I would have yielded 25% on my risk. The equivalent of this trade in traditional investing would mean, since I'm only risking $400, the equivalent trade would be for me to spend $400 to buy shares and then need a 25% rally to deliver the same yield on my risk. Except in this case here, I don't even need a rally. In fact, the stock can fall a lot more to an all-time low and I can still win. All I need is price not to fall below 35 and I'm golden to deliver a 25% yield on my risk. So that's how these things are pretty attractive. I can spend $5,000 to buy 100 shares and hope for a 20% rally, or I can collect the grand and don't need anything to deliver a 25% rally. I mean, 25% yield on my risk. I prefer option B. I do not want to buy and hope, but you know, maybe a blend of both. If somebody buys share, let's say I want to buy 200 shares, then I'll buy 100 shares and I'll sell 1 put. This way I'm hedged. One has room to fall, the other one does not, so I'm not all in. Okay, so this is a visual of a credit put spread. So I don't need money to cover this. So the broker, if I open this trade, they're comfortable because they have a maximum loss calculation number. So they have their own risk desk, risk department that looks at who's taking risks and what kind. In this case, they're totally okay with it because they know the worst case scenario is covered. It's $400 per contract. So if I have $10,000 account and I'm doing 1 contract, they know I'm only risking literally $400. If I do 2 contracts, I'm risking $800. So they'll keep that balance, say, okay, given his or her account, given how many trades they have open, they do their calculations. This is totally normal, no issues. Okay, so there might be some complications later on, like with assignments, early assignments and things like that, but the maximum loss is predetermined mathematically. So they are okay with that. How do I close a trade? Okay, good question. So I almost never hold the trade 50 days through its lifetime. If it's 50 days or 10 days, I usually close it early. How do I close a trade? So this is a credit put spread. Look, limit credit. So I collect credit, $100 per contract. So let's say I already have this trade on. To close it, I would simply reverse it. It becomes a debit. So at the time when I'm closing it, if enough time had passed and or the stock had rallied, maybe it drops its value to 30 cents. So then I would only need to pay 30 cents to close it. If that's the case, I collected one, I paid 30 cents, I made 70 cents. So that's called leaving money on the table. Guess what, folks? It's part of doing business. If you're in the process, if you're in the market for making boring, stupid, easy wins like this, I got your number. So this is boring by design. If you have a portion of your portfolio dedicated to boring trades, you're doing things right. So not every trade needs to be a home run. Oh, let's get lucid calls and make 6,000% in 10 hours. Yeah, you could do that, but you're going to whiff a lot. Whereas this, you're guaranteed wins unless something extravagant happens. So I prefer this. It's like a race car driver that places top 5 the whole season. They win championships. And the person that goes balls out every corner, they may win races here and there, but they may or may not win a championship because they're going for broke every time. So this is the, excuse me, the concept. Taking calculated risks, extremely high odds in your favor, that's our focus. And what I deliver to you, whether you end up in the chat room or not, is a 15-minute video with every trade setup, describing the macroeconomic conditions, describing the current microeconomic conditions of that particular company, and telling you why I'm doing this today. You know, in other words, what's my thesis, and also what would get me out, like a stop level, like stop loss, ouch, that's too much pain, or hey, I got enough wins, what will get me out? And then a table and a description of all the ways you can do it. Buying shares, buying call spreads, which we haven't discussed, and selling puts, which we have discussed, or selling a put spread, which is what you were looking at right here. This would be it. So if
Yeah, Nick, and I
nothing
don't know,
less, if
not sure
nothing
how you're
less,
doing
this
with
is your education.
not sure how
for
you're doing
the-
with time, Nick, but
Okay,
we do have to, yeah, just in a couple minutes here, whenever you do have time.
that's it. I'm wrapping it up. So I was going to end it with don't approach it that this is a trade alert service. You'd be missing my freaking point. The point is you're going to learn. Every video is a whole class. And if you see one every 2 weeks, you may see that's like a class every 2 weeks for dirt cheap, literally dirt cheap. And if you can find it in your heart to get into the chat room, I can guarantee you knowledge beyond expectations. Not that I'm going to tell you what's the meaning of life, but I bet you you're going to find a few aha moments and then you go, what? Sunday, for one of the things you would get if you get into the next level chat room, Sundays, 2-hour webinars every Sunday, free, with about 100 to 150 tickers shared with spreadsheets that you ask for. You send in the tickers you want. I will review them every Sunday out of my own time. Benzinga does not require that. That's me. So I promise you there's way more than what you're paying to get into the chat room eventually. But first step, you got to hop into what Rodrigo's offering you here today. All yours, my friend.
Okay. All right, Nick, thanks for joining here, guys. I'm going to stay answering a couple questions here, Nick. Thanks for being around here for the folks.
I appreciate your efforts and Benzinga's efforts. I mean, we've been working together since 2011 for a reason. We're doing something right.
Yeah, and the folks love it here. So, guys, I'll be good to see you, Nick. I'll see you here probably in a day or two, very likely. So,
all right, see you later, buddy.
All right, man. Guys, I'm putting the link for Nick's trade ideas in the chat room, guys. Okay, and I'll put my contact if anybody has questions as well. Feel free to reach out. All right, guys, I posted the link there for Nick's trade ideas, questions as well. If you do want to follow up, if for some reason you missed the link, you can go to the YouTube video. That's where you can find the link on how to join Nick's trade ideas for $7 a month until midnight. If you have a question, guys, just reach out, contacts there. Thanks a lot for being here, and we'll see you guys on the next time.